Hey everybody, I'm Mike DeSepoli and welcome to the Heritage Market Minute for the week of Monday, November 22nd, 2021. Hope you had a great weekend. We got a lot to talk about here this week in the markets. We're seeing a lot of ugly action in these markets, a lot of volatility rearing its ugly head, which is not that unexpected given how overbought the markets had become in the short term. But nonetheless, these things happen from time to time, and it's always a good activity for us to revisit and remind ourselves that this is a feature of the market and not a bug, right? Every time the markets go haywire, people think there is something wrong, there must be a problem, this is the end of days. The financial media pounce all over this stuff and talk about how this is the big one, this is the crash, the one that all the bears who have been bearish since 2009 have been waiting for. I'm here to tell you that this is not that market, this is not that time, and it is not time to run for the exits. But we don't operate based on emotions or hyperbole. So let's get into the facts here this week and talk about some of the factors driving the market and how we think that this all fits together. So first, the big news of the week is President Biden choosing to stick with Jerome Powell, Jay Powell, as the chairman of the Federal Reserve. Right? He was the odds-on favorite to be renominated, but there had been some talk over recent weeks that there was a close second in Lael Brainerd being considered for that post. So what Biden opted to do was renominate Powell as the head of the Federal Reserve and elevate Lael Brainerd to the vice chairmanship, or chairwomanship, I should say. So both of them being really integral part of the Fed over the last couple of years. We think this is important because this is something that was hanging over the markets for quite some time, and markets don't like uncertainty, as you know. So now that we have this decision behind us, this should be something that the market can move past. Now, if you look at the markets, the activity last couple days, things don't look good, right? Now, we talked about last week, the markets had reached overbought levels, okay, in the short term, not long term, just in the short term. You know, after that correction that we had towards the end of October into early November, the market had been on an absolute tear, right? And nobody has a problem when the market is on a tear. It's only when the market starts to reverse course a little bit that people throw their hands up and get concerned. So let's take a look at the market here. We got to bring ourselves some perspective around the situation and talk about the action that we're seeing. So this is a look at the NASDAQ index, right? This is our NASDAQ 100, the big mega cap tech stocks. You know, really all the tech in this index is very well represented throughout the market. This also overlaps into the S&P 500 and the Dow Jones. But what you're looking at is the NASDAQ over the last 14 months, right? And what we have highlighted on this chart is the different corrections that we have gone through during this period of time. And right, anytime we go through a correction, they always feel the same way. People think it's the end of days, and then the markets move on to new highs, and we forget where we came from, right? So this is just a reminder that corrections are a feature of the market. They are not a malfunction. There is nothing wrong with the market when corrections happen. Corrections can find a whole different variety of reasons for what sets them off. In this case, we believe in the short term, after a very parabolic move from the early November lows into the current levels, the market needed a little bit of a breather before we head into some favorable year-end seasonality, right? So when we look at this over the course of the last 14 months, we have seen 5 distinct scenarios where the market pulled back, and these corrections serve a larger purpose. They allow markets to re-energize themselves. They allow markets to work off some of these overbought or frothy conditions, and they also represent buying opportunities when we play them right. This is why we have cash in our strategy. This is why sometimes when we scale into an asset, we will do it in measured steps, because picking the exact bottom is very difficult. Sometimes we will buy a stock or an ETF or a fund, and it might move a little bit lower. That does not mean that we got it wrong. It's just another opportunity for us to buy it cheaper and bring down our average cost. So we want to show you this in the perspective of what's going on, because people are running around right now like their hair is on fire, and this market is essentially 4% away from all-time highs. So it's time to take a deep breath, relax, step away from the computer, and remember, over this last 14 months that we're showing you here on the screen, the NASDAQ has gone from 11,000 to almost 17,000. So corrections do not mean the story is over, that the good days are behind us. This is just another opportunity for investors to recalibrate, reassess their portfolios, which is exactly what we're doing, using this to find buying opportunities to move this portfolio forward. Another thing we want to show you is the Fear and Greed Index, right? We refer to this a lot when markets are oversold. We use this as an indicator that markets might be showing too much fear, too much uncertainty, too much selling. And of course, the sword cuts both ways. The Fear and Greed Index just about a week ago, week and a half, was trending in the high 80s, showing extreme greed, a little bit overbought. That's one of the many indicators we look at to determine that this market was probably due for a little bit of a pause. Here we are now at 56, almost in neutral territory. And just goes to show you that this market sentiment, the moods around the market, have snapped back in a very quick fashion, which is the purpose of these larger corrections, right? We can't have excess optimism flowing through the markets for extended periods of time because that is how investors get hurt. So now that this has pulled back into a more normal range, we think the market is looking to try to find a bottom here. Most of the correction of the last week or so has been concentrated in the technology and growth names. Some people kind of making an assessment that Fed Chair Jerome Powell, who we've had for 4 years already at this point, might be on a path to raise interest rates at some point sooner than the market expects. Now, as far as what the market expects, we think the market is expecting interest rate increases in the second half of 2022. We still think that will be the outcome, but sometimes the market throws a tantrum like children do and tends to overreact first and consider the facts later. So we think that is what we are seeing here today. So we encourage everybody, keep calm, invest on. We have a plan. We are working that plan. We feel very confident in where this market is going to take us. And really, when we look back to the end of last November, right before Thanksgiving holiday, which we have here with the holiday shortened trading week this week, markets pulled back ferociously. People thought it was the end of days, and then the market went ripping higher for the 5 to 6 weeks that followed to end the year. So if you have any questions, reach out to us. Just want to give you some perspective on what we see in this market. You know, red on the screen is never fun, but we see opportunities when the markets are down, and we're going to try to take advantage of them to the best of our ability to help you guys move your portfolios forward. So reach out to us with any questions. We hope you have a very happy Thanksgiving. We're very thankful for you guys tuning in with us, following along, and the opportunity to work with you all. So enjoy the holiday with family and friends. Stay safe, and we'll see you back later this week for the Heritage Market Pulse.